Good day. Thank you for joining me. My name is Matt. I cover IT stocks for PSG Wealth. And in today's presentation, I'm going to take you through the quarterly results for Amazon and Alphabet. So on Alphabet, the main takeaways were that the results mostly missed expectations. YouTube ads were weaker than expected. Google Search and Cloud drove the overall revenue growth of 23%. And then on Amazon, we've got the results which also missed expectations. Operating income decreased by 60%, and Amazon closed down 14% the day after results. Results were released after the close. So the next day they were down 14. And since then, shares have declined about 20% since the results. So it's lost another 6 or 7% since then. And the reason why I normally mention the results versus expectations is because these companies have been exceeding expectations for so long. There's always going to come a point where they were not able to meet the expectations. They've been priced for perfection for so long, and now they're starting to disappoint. And what we've seen in the last couple of earnings releases of late, when these high growth, long duration stocks miss expectations, they get smoked. So the results versus expectations usually accounts for a lot of the short-term volatility as well, which has been quite big as of late. So let's just focus on Alphabet before we go to Amazon. So key takeaways from the results were that revenue grew by 23%, and that was a miss. It was driven by search advertising and cloud. The search ads were driven by retail and a continued recovery in travel. The YouTube ads grew 14%, but they missed expectations by $710 million. And the miss comes from very high expectations. YouTube ads were elevated during the pandemic. And then there's also an increased competition from TikTok, which is capturing a growing share of time from social media. Operating margin was unchanged. Net income declined 8.3%, and that was driven by a loss on equity securities of about $1 billion. In the prior period, there was a gain of nearly $5 billion. So that's where the discrepancy between operating income and net income came from. Diluted EPS was down 6.3%. The cloud operating loss narrowed slightly from $974 million to $931 million, and the other bets had an operating loss which was much the same of $1.1 billion. And then lastly, the board of directors approved up to $70 billion in share repurchases. So just on the valuation for Alphabet, we value them based on a peer EV sales multiple and we use that as the guide. And this is included in the report, and the Alphabet share price has bounced around this value. But we do place much more weight on a negatively skewed risk-reward profile. And what I mean by this is that interest rates are rising, we're going into a high tax environment, inflation is impacting the consumer and advertising budgets, and the environment just tips the scale. So while our intrinsic value is based on peers, our sell recommendation is influenced by taking these other factors into consideration as well. Then on Amazon, we've got also quite disappointing results. The sales increased only 7% to $116 billion. It's one of the slowest growth rates they've got on record. In the prior period, they were up 44%, so huge deceleration. Operating income decreased 60% to $3.7 billion. Because their operating margin is so small, that operating income can be very volatile. Operating expenses increased 13%, and in the earnings call, management focused a lot about costs. These guys are impacted by inflation, a lot to do with higher transport and fuel costs. The cloud business continues to do quite well, grew 36.6% to $18 billion, and operating income was about $6.5 billion. The rest of the business had an operating loss of $2.8 billion. And then included in other expenses was a pre-tax valuation loss of Rivian, which is it's basically a Tesla which doesn't sell cars, and that loss was $7.6 billion, and that drove the overall net loss to about $3.8 billion. Operating cash flow, free cash flow, negative. Amazon, we valued very similarly to Alphabet, in that we use some of the parts based on EV sales multiple, but also we use this as a guide. We place a lot more weight on the negatively skewed risk reward profile, and this is supported by our reverse DC, which is also included in the report. But just like for Alphabet, the environment's not great for long duration stocks, particularly Amazon. Significant risks still exist.
Thank you for joining this presentation. If you would like to make a trade, please contact our dealing desk. And lastly, please take note of the following disclaimer.